How big an opportunity is this in equities, even as bonds are priced to perfection?
I think you can be patient and wait a while. I remember the '87 stock market crash, which really didn't even feature on the chart. You just put up amazingly. There is time. A lot of damage has been done. You've had a financial shock. You're getting an economic shock. You've got to see what kind of policy responses you get, how long you take to get them.
Okay.
The market will settle at lows.
So, Bob, let's talk about that. The kind of policy response that would be the circuit breaker right now. You're anticipating recession. Earlier on in the program, you said this might be the one, the end of the bull market. To be honest, technically, we're not that far off anyway.
Take tariffs off?
What is the circuit breaker? What would you need to see to say, good to go?
I think you need a combination of monetary and fiscal. On the monetary side, the Fed should go to zero. The ECB should cut rates 10 basis points. They should do more large-scale asset purchases. They should do targeted long-term repo operations. Number 3, the Fed should also think about expanding its balance sheet. On the fiscal side, you need to see programs come out immediately to get operating cash to small businesses. You don't wait for the data. By the time you see the data, it's too late, and these small businesses will have been forced to lay people off.
So this is the key question. If there is a coordinated effort, fiscal and monetary, exactly as you laid out, will it be a V-shaped recovery in markets? Are you going to see just prices spike? Are you all in buy? Or is this going to be a longer-lasting issue regardless?
No, you put in a bottom here. We've never had like a V-shaped recession. To me, this is crazy. And people say V-shape, U-shape. There's a big difference, right? The V-shape is just a minor market event. And every recession has been U-shaped. We've come out the other side, or we all wouldn't be here. So this is about a lot of damage has been done, assessing the damage, trying to figure out, is this a 3-month, 6-month, or 9-month event, and then are policies enough to pull us higher?
Our audience wants to know what to look at. Bring up this chart if you would. This is one of the global litmus papers. This is what the sophisticates look at. In this case, trade-weighted Swiss franc. Okay, you don't need to watch this at home, but Bob Michael knows this well. John, you know the blue circles 2015 of stronger Swiss franc as we go. We're back to that point of tension now. Which is the indicator, that point of tension you look at as we go through the evening into Asia tomorrow and then into the New York Open?
There are quite a number of things I'm looking at. I thought this was a particularly messy close today where equity sold off and fixed income.
That was Farrell finally putting in the sell tickets.
And it could be. And fixed income didn't rally, which is starting to tell me that investors understand that fixed income in and of itself, treasuries, won't be a hedge for a risk-off environment. I'm looking at yen. Yen has rallied a lot in here versus the dollar. We're heading into the fiscal year end.
Bob Michael, just to jump in, after a 29 basis point move on a 30-year treasury, are we seriously sitting here and saying that the treasury market has lost its risk mitigating characteristics after a move like that?
I think it has. I'm hearing that more and more. I don't think anyone's going to come in here and be selling over the near term. They're going to joyride this all the way with the Fed down to zero. But I think the expectation that you can buy enough U.S. government bonds to offset either an equity market decline or a sell-off in credit or a sell-off in peripheral government bonds is fading.